Inheritance tax, or IHT, can significantly impact the assets you leave behind. However, with strategic planning, there are legal ways to minimise this burden. Today we'll explore 5 key methods to reduce your IHT liability in the 2025-2026 tax years. I'm Paul Britton, a solicitor at Britton and Time Solicitors based in London. I have over 10 years of experience dealing with wills, administration of estate and probate issues. Every individual has an allowance of £325,000 which is taxed at 0%. This is known as the Nil-Rate band. Additionally, if you pass your main residence to direct descendants, like your children or grandchildren, you can benefit from residence Nil-Rate band, which is an extra £175,000 tax-free. For married couples or civil partners, these allowances can be transferred to a surviving spouse upon the death of the first spouse by gifting their entire estate to the other, allowing up to £1 million to be taxed at 0%. You can gift up to £3,000 each tax year without it being added to the value of your estate. If you don't use your allowance in the previous year, you can carry it forward, allowing a potential £6,000 to be gifted tax-free. Regular gifts from surplus income can also be exempt, provided they don't affect your standard of living. If you own a business or agricultural property, you might be eligible for reliefs that reduce the value of your assets for inheritance tax purposes. Currently, up to 100% of relief is available, but changes are coming into effect from April 2026 in accordance with the 2024 autumn budget. From then on, only the first £1 million of qualifying assets will receive the full benefit, with the remainder receiving 50% relief. Planning ahead is crucial to maximise these benefits. Setting up trusts can help manage how your assets are distributed and potentially reduce inheritance tax further. For instance, placing assets into trust removes them from your estate after 7 years, provided you don't retain any benefit from them. Trusts can be complex, so it's essential to seek professional advice to ensure they are set up correctly and align with your estate's planning goals. Pensions can be a tax-efficient way to pass on your wealth. Defined contribution pensions aren't subject to IHT. If you die before the age of 75, your beneficiaries can inherit your pension pot tax-free. After 75, they may pay income tax on withdrawals, but the pension remains outside your estate for IHT purposes. However, this too is subject to change as of April 2026. Proactive estate planning can significantly reduce the impact of inheritance tax on your loved ones. By understanding and utilising available reliefs and allowances, you can ensure more of your wealth is passed on according to your wishes. For personalised advice and assurance with your estate planning, contact Britton and Time Solicitors today.